Well, good afternoon then, folks, on Thursday the 27th of July, as we look ahead to the ECB later on this afternoon. A little bit later on this afternoon, we can see the ECB interest rate decision at 1:15, and obviously the press conference that accompanies it at 1:45. We'll have a quick look at what is to be expected, what we are looking at ahead of the release, and then we'll obviously update in today's US video after we have heard from Christine Lagarde a little bit later on this afternoon. But the European Central Bank, ECB, will raise interest rates by 25 basis points, as you can see. Previous 4%, consensus 4.25, and will bring the deposit rate 3.5 to 3.75% for the ninth time in a row. So hiking cycle across the board in all of the major economies obviously continues, but what we are doing is we are approaching the end of the hiking cycles in these respective economies. Now, with the Fed out obviously last night, which hiked rate by 25 basis points, and unless we get some strong CPI prints, you'd have to imagine that's probably done for the Fed last night. Looking ahead to the ECB, markets are currently, kind of pricing in a further 50 basis points worth of hikes. 25 today, potentially another 25 at the September meeting. Now, I would suggest there's probably a 50-50 chance of a further hike at the September meeting. Obviously, it's a foregone conclusion for today's meeting, but that September meeting, I do think it's a little bit undecided as to whether we do or do not get an interest rate hike. Now, inflation is still higher in the Eurozone than it is in the US, so the ECB have a little bit more work that they have got to do in order to get inflation under control. But one problem that the ECB have that the Fed do not is that the Eurozone is in a technical recession. It is not got the growth that the US has. So the US has slightly stronger growth and slightly less inflation. The Eurozone has slightly more inflation and slightly less growth, right? That is a bit more of a difficult situation for the ECB to be in. Now, they have to keep raising interest rates as of today's meeting, but I don't think they will want to come across dovish. I think they will want to signal some sort of hawkish rhetoric surrounding this hike, suggesting that they will keep the foot on the gas, but I think they will probably say that they're going to be data dependent rather than what they have alluded to in their recent meetings, that we are going to continue hiking interest rates. There is no end in sight, and I kind of feel as if they probably should stick to that in order to keep inflation cooling down and keep asset prices subdued. But in terms of the reality with the economy in the current state that it's in, and inflation is trending lower, they will want to see these policy decisions take effect rather than kind of just hiking forever. What then that means at this meeting is, to me, they'll probably want to give off some sort of hawkish rhetoric. Now, whether markets then choose to believe that is a completely different question, but that's how I feel they will play it going into this meeting. Going into this meeting now at 1:15. But then, what in terms of what it means for markets? If we just look at markets across the board, I think bonds will be in focus. And they do come in hawkish. There's a bit of a level across here in the bonds that I do think is worth paying attention to. Now, any break below here, let me change the color just so you can see it a bit better. Any break below there, I think, will be significant below that black line at 132.90. Now, it is a pretty good support level. Any break below there would be some hawkish signaling, and then potential for interest rates or yields then pushing higher. In terms of that then pushes higher, I think your line in the sand is kind of 140, and we're a little bit away from that. I don't think we'll reach that in today's session, but that level to the downside in the bonds off the back of hawkish rhetoric is something to keep an eye on, as we do have a level on the 10-year yield as well, right? And that would prove supportive for euros. It would decrease the yield differential between the Europe and the US, which will help send euro dollar higher. Now, euro dollar higher in the aftermath of the Fed last night, so markets seemingly suggesting that the Fed are done. That is probably to be the likelihood, unless we get some strong CPI prints. So some weak dollars yesterday if you can get some strong euros, get a hawkish central bank, the ECB continuing to say they're going to keep the foot on the gas. Whether they actually hike rates or not is a different question. But if they do keep the foot on the gas in terms of their rhetoric, that should be a reason for some more euro dollar upside, and should see you in test of these highs at least at 112.50, which would hopefully send yields through that resistance level, bonds through that support level, and would be supportive for the euro. You look at the 2-year yields, you had a pretty good resistance level on the 2-year yields, which on some hawkish rhetoric would send the 2-year through 330, right? And that is the situation on a hawkish rhetoric, right? Bonds through the lows, 10-year yields through the highs, euro dollar higher, pairing euro strength with US dollar weakness would be the trade for me in that scenario. Now, if they do push back on the rate hikes, right, they have stuck to the rhetoric of no end in sight. They are not looking at stopping interest rates yet, and that is what they have suggested at previous meetings and throughout the previous commentary. Now, if they push back on that, and they do say that they're going to be data dependent going forward, but they continue to stick to the script of being data dependent going forward, but they do say something along the lines of they are approaching the end of their hiking cycle. They are looking at concluding it, or they're not looking to hike interest rates much more, or many more times is probably better English. Then I think the trade is long stocks. So if bonds start to then push higher, yields then start to push lower. In terms of looking at levels, I mean, you got a bit of a level to the downside here on yields, which is obviously a substantial way away. So in terms of do we get that, maybe not in today's session, but if we do get down there and move towards testing those sorts of levels, I do think it's an interesting chart to look at on the euro stocks. Now, on a dovish central bank where they do suggest that there is an end in sight in terms of the interest rate hikes, and they are looking at concluding their interest rate hiking cycle at some point coming up, this then becomes an interesting chart to keep an eye on, right? You've got all these highs lining up here. You've also then got these highs back here, the post-COVID highs posted in November of 2021. So, a pop higher. All these times markets have sold off these highs here. You look at this through here, you look at this through here, you look at this through here. That's aggressive selling each time we came off of these levels. Substantial movement lower. You'd have to imagine there's probably some stop losses above these levels ready to be hit, and you have to imagine that it's probably a good trade on a break through that. You get a dovish Fed last night, or more a dovish reaction to the Fed last night, and come across to the ECB. If then they give up the hawkish rhetoric as well, and start to suggest that they are moving towards the end of a hiking cycle, that is again dovish out of the two major central banks, and that is a reason for some stock upside. Goes in line with the movement over the course of today's session so far. A bit of a pop higher through that resistance level should accelerate this move to the top side. So I think a dovish central bank or a dovish ECB today, euro stocks through the highs here makes sense. The DAX, not quite at all-time highs itself, but is approaching up there. The all-time high back in the DAX is this across here. Euro stocks yet to reach fresh all-time highs. But in terms of, do you want to really buy it straight up into that? I'm not sure, but if the euro stocks can get above that, you'd have to imagine positions are added through the highs, and that trade would make sense if it gets through the highs. So off a dovish ECB goes in line with the dovish Fed from last night. Euro stocks through the highs seem interesting. Euro dollar maybe not so much, as you'll have weak euros, weak US dollars. Not the best of trades. Bonds get through the lows, yields get through the highs off the back of a hawkish reaction to the ECB today. Euro dollar longs make absolute sense, at least up until 112.50. And I think I'd stay away from the stocks personally. So dovish reaction to the central bank, stocks through the highs seem a decent play. Hawkish reaction to the central bank, euro dollar seems a decent play. Bonds through these lows would also seem a decent play, as it is a pretty good technical level. So a couple of opportunities off the back of a dovish, opportunities are in stocks. I think off the back of a dovish reaction, off the back of a hawkish reaction, I think your opportunities are in bonds and euro dollar. And that is how I feel heading into the ECB later on this afternoon. We'll be back with the US video, the pre-US video, a little bit later on, where we'll break this down once we have heard what they have to say for themselves. So do tune into that, and we will update further a little bit later on.